Welcome, everybody. It's Scott Riley, the Market Update Desk, December 11th, NMLS number 157524. We did a quick breakdown yesterday of the headline quarter point Fed cut. We wanted to go into some more depth on that and talk about what's going to be a changing of the guard coming very soon within the makeup of the voting members of the Fed. So we got our quarter point cut as expected, but the market was pleasantly surprised on the more dovish commentary from Chairman Powell than what had been initially feared. Um, the one thing Powell did do is he set the bar fairly high when talking about multiple rate cuts going forward, saying the Fed is now in the upper bounds of the neutral rate, meaning they think they're pretty close to where they need to be. Um, Now, one thing he did was went out of his way to say that the BLS is likely overstating job growth by almost 60,000 jobs per month. Now, because of that, since April, he feels we've actually been losing about 20,000 jobs per month. He may have some insight into next week's BLS report that we haven't seen yet. So it's going to be very interesting to see if that is potentially very bond friendly when we get that report next week. Now, on inflation, Chairman Powell explained that services inflation is coming down, but it's being offset by a rise in goods prices, but only in sectors that are affected by the tariffs. And he did indicate that he thinks the impact of tariffs is going to wane out in Q1 of next year, and that if we took out what is the potential impact of tariffs, he thinks the inflation is really closer to the low twos, which is really where the trueflation number, which is another metric, is showing that we're out. Now, a big surprise that we really liked was the Fed's announcement that they're going to start to buy 40 billion of treasuries per month starting this Friday, tomorrow. Now, this lines up potentially very well with Treasury Secretary Bessent's plan for issuing more short-term debt than long-term debt. And we think that this could be a very positive thing for mortgages as we go forward. Now, when we break down the dot plot and commentary within the Fed meeting yesterday, we saw that there were three dissenters. Fed Governor Stephen Miran, he wanted a 50 basis point cut or a half point cut, while the Chicago Fed President Austin Goolsbee and Kansas City Fed President Jeffrey Schmidt voted against the cut and wanted a pause. Now, it's very interesting because Goolsbee's been one that went out of his way to talk about we have space for multiple rate cuts. When he was talking last year, he was talking about maybe 7 rate cuts in the next year, year and a half. Now he's trimming that. Now, Schmidt's always been the Grinch that because he's always been dissenting and think we either need a pause or rate hikes. Steve Miran, he's the super dove. He was just recently installed a couple of months ago. He wanted the half point cut. Now, as we go forward, the makeup of the dynamics of the Fed is going to be very interesting to follow, as it's likely going to turn more dovish in 2026. The reason for that is the rotation of Fed presidents that will be leaving, which are the aforementioned President Goolsbee, Kansas City President Schmidt. Both those are very vocal hawks. And the St. Louis Fed President Alberto Musalem and Boston Fed President Susan Collins, who also tend to be on the more hawkish side. The three hawks and somewhat centrist who are going to be replaced with the Cleveland Fed President Beth Hammack, Philly Fed President Anna Paulson, and the Dallas Fed President Lori Logan, and Minneapolis Fed President Neil Kashkari. Now, Kashkari gives a lot of speeches out there, but we just haven't had him as a voting member until what's going to be coming up. Now, all of whom are going to be less hawkish than what they're replacing. And the new Fed chair starting next year is likely going to be much more dovish than what Chairman Powell is. So it's going to be interesting to see the movement and momentum behind that. When we look at the dot plot, there were 3 voting members who thought we should have a quarter point hike, 4 that thought we should have no cuts, 4 that were in the 50 basis point range, 2 wanted to be in the 75 basis point range cut, one of over 100 basis points, and one thought the neutral rate should be over 150 basis points. That's probably Stephen Miran. Now, the other item that came out yesterday is initial jobless claims. Now, if you remember last week, we had a big drop in it. We had a bump up by 44,000 in initial claims to 236,000. We thought we would see this bump because of the Thanksgiving holiday and how that skews things from last week's number. Now, a surprise was continuing claims fell by almost 100,000 to 1.84 million. Now, when we dig deeper into it, there's a reason why. Most states allow continuing claims for 26 weeks. And if we look back 26 weeks ago to late May, early June of 24, there was a spike in initial claims. Now, those people are starting to fall off the continuing claims category. And that's why we're starting to see a little bit of a dip in that. We'll see what happens next week, where maybe we'll probably likely get a little bit of a bump up in that. Now, in mortgage-backed securities and 10-year treasuries, we're starting to see a stochastic crossover in both those categories. Now, this bodes well for potential positive movement on mortgage rates. We see the treasury now. It hit a peak of 4.21 as a Tuesday. We've now fallen 10 basis points down from that to 4.11. In fact, yesterday in the Dow, we saw a 500-point jump. Today, we're up and over 600 points. So big jumps in the Dow, positive movement on treasuries. These things bode well for, if we cross our fingers, what looks like could be a negative jobs report next week. Maybe we can get to that 4.00 level of the 10-year treasury, get the positive momentum down, which brings our mortgage rates down, and then we can start getting really excited about maybe stabilizing in sub 6% rates. Give us a call. We'll break down all this information, help you get pre-approved, look at potential refinances to save you cash flow. Give us a call, 616-293-2189. Scott Riley, the Market Update Desk, your original singular market news source for West Michigan. Take care.